Chinese Proverbs for Money and Success. Are you tired of losing money following the latest investment trends? Do you feel like successful investing is a secret club you'll never understand? There are two types of investors in America today. The first type, they chase hot stocks and crypto coins. They follow Reddit tips and TikTok gurus. They buy high, sell low, and wonder why they're always broke. They think investing is gambling with better marketing. The second type, they follow wisdom older than Wall Street, older than the New York Stock Exchange, older than America itself. Principles that created fortunes for 5,000 years. Here's the shocking truth nobody talks about. While day traders lose 90% of their money in the first year, while retail investors chase meme stocks into bankruptcy, while financial advisors push expensive mutual funds that underperform, Warren Buffett built a $120 billion fortune using ancient Chinese wisdom. Not modern portfolio theory, not technical analysis, not algorithmic trading. Simple proverbs passed down through dynasties, principles that survived wars, famines, and economic collapses. Wisdom that turns ordinary people into extraordinary wealth builders. Today, I'm going to reveal 7 Chinese proverbs that Warren Buffett has quietly used for 60 years. Proverbs that explain his entire investment philosophy. Ancient secrets hiding in plain sight. If you're ready to invest like the Oracle of Omaha using 5,000-year-old wisdom, comment Buffett wisdom below. Because what worked for Chinese emperors still works for American millionaires. Let's start with the proverb that made Buffett his first million. Proverb 1. The best time to plant a tree was 20 years ago. You keep waiting for the perfect moment to invest. Market timing, economic predictions, waiting for the crash, waiting for the bottom, always waiting, never starting. Meanwhile, compound interest slips away forever. Ancient Chinese farmers understood something. Wall Street forgot. Time in the market beats timing the market. The second best time to plant is now. Warren Buffett learned this lesson at age 11. He bought his first stock in 1942. City Service preferred shares at $38. The stock dropped to $27. Young Warren panicked and sold at $40. A small profit, but a massive lesson. The stock later soared to $200. From that day forward, Buffett embraced the tree planting philosophy. Buy quality companies, hold them forever. Let time do the heavy lifting. His teacher, Benjamin Graham, shared ancient wisdom. In the short run, the market is a voting machine. In the long run, it's a weighing machine. Translation: short-term prices reflect emotion. Long-term prices reflect value. Buffett planted his money tree in 1965 when he bought Berkshire Hathaway. Stock price, $19 per share. Today, $627,000 per share. That's a 3,300,000% return. Not through brilliant timing, through patient planting. The deeper truth Buffett discovered was that wealth grows in decades, not days. In 1988, Buffett bought Coca-Cola stock. Critics called him old-fashioned. Soda is declining. Health trends are changing. Buffett ignored the noise. He saw a global brand with pricing power, a company that would grow for generations. Today, that Coca-Cola investment is worth $25 billion. Annual dividends alone, $700 million. The tree planting principle teaches us, stop trying to time perfection. Start investing in excellence. Every month you delay costs compound interest. Every year you wait costs exponential growth. The Chinese understood this 5,000 years ago. Buffett learned it 60 years ago. When will you? But planting trees requires knowing which seeds to choose. Proverb 2. When buying a horse, look at its legs. You buy stocks based on headlines, hot tips, social media hype, price movements, and momentum. You never look under the hood. Ancient Chinese horse traders had a different approach. Examine the foundation before you buy anything. Strong legs carry heavy loads. Weak legs collapse under pressure. Warren Buffett applies this wisdom to every investment. He doesn't buy stocks, he buys businesses, and he examines their legs thoroughly. Strong business legs include consistent earnings growth, low debt levels, high profit margins, competitive advantages. Weak business legs include erratic profits, heavy debt loads, declining margins, no competitive moats. In 1988, Buffett examined Coca-Cola's legs: global brand recognition, strong; pricing power, strong; distribution network, strong; debt levels, manageable. He bought $1.3 billion worth. Critics called it boring. Where's the growth story? Buffett smiled and quoted ancient wisdom. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Meanwhile, other investors chased exciting stories. Biotech companies with no profits. Tech startups are burning cash. Energy companies have massive debt. Shiny horses with broken legs. When markets crashed in 2000 and 2008, the shiny horses collapsed. Coca-Cola kept running. The deeper truth Buffett discovered was that foundations matter more than facades. Look at Apple, Buffett's largest holding: $394 billion in annual revenue, $100 billion in annual profits, $29 billion in annual dividends, strong legs supporting massive value, versus many popular meme stocks: no revenue, no profits, no dividends, pure speculation on weak foundations. The horse buying principle teaches us: examine the business, not the stock price. Read financial statements before earnings calls. Study competitive advantages before buying shares. Understand the business model before risking capital. Strong horses win long races. Weak horses collapse before the finish line. But even strong horses need the right price. Proverb 3. A gem cannot be polished without friction. You panic when your stocks drop. Red days feel like disasters. Market volatility terrifies you. You sell when prices fall. Ancient Chinese gem cutters understood something modern investors forgot. Pressure creates value. Friction polishes diamonds. Stress reveals true quality. Warren Buffett embraces market friction like a gem cutter embraces his wheel. When others see a crisis, he sees an opportunity. When others feel fear, he feels excitement. During the 2008 financial crisis, banks collapsed. Retirement accounts evaporated. Fear paralyzed the market. Everyone was selling. Buffett did something different. He bought $5 billion of Goldman Sachs preferred stock. He invested $3 billion in General Electric. He purchased railroad stocks while others fled. Critics called him crazy. The financial system is collapsing. This could be the end. Why catch a falling knife? Buffett smiled and quoted his favorite Chinese wisdom: be fearful when others are greedy, and greedy when others are fearful. The friction of 2008 polished his returns beautifully. Goldman Sachs investment, $3.7 billion profit. General Electric deal, $1.2 billion gain. Railroad stocks, massive long-term returns. The deeper truth Buffett discovered was that market stress creates the best buying opportunities. In March 2020, when COVID crashed markets, amateur investors panicked and sold everything. Professional investors followed the herd. Buffett accumulated bank stocks and energy companies. The friction lasted 6 months. His patience paid off for decades. Consider his Apple investment timeline. 2016, bought during iPhone sales concerns. 2017, added more during China trade fears. 2018, increased position during tech sell-off. 2019, made it his largest holding. Each friction point created better entry prices. Each moment of stress increased his eventual profits. The gem polishing principle teaches us: volatility is your friend if you think long-term. Market crashes don't destroy wealth, they transfer wealth. From the impatient to the patient, from the emotional to the rational. Chinese gem cutters needed steady hands during friction. Successful investors need steady nerves during crashes. But steady nerves require philosophical foundations. Proverb 4. The wise find pleasure in water, the virtuous find pleasure in hills. You chase the latest investment trends. Whatever's hot on social media, fast-moving momentum plays, quick profits and instant gratification. Ancient Chinese philosophers recognized 2 types of wisdom. Water seeks the easiest path and changes direction constantly. Hills stand firm through storms and endure for millennia. Warren Buffett chose to be a hill. While other investors flow like water, chasing biotech one year, crypto the next, following momentum from sector to sector, Buffett plants himself like a mountain, same strategy, same principles, for over 60 years. His investment philosophy hasn't changed since 1965. Buy undervalued companies with strong fundamentals. Hold them forever. Let compound interest work its magic. No day trading, no market timing, no chasing hot sectors or trendy stocks. Just hill-like consistency. In the 1990s, everyone chased internet stocks. Buffett bought boring businesses. Dairy Queen, Nebraska Furniture Mart, insurance companies. People mocked his old economy thinking, he doesn't understand technology. The internet changes everything. When the dot-com bubble burst, the water-like investors lost everything. The hill-like Buffett kept growing wealth. The deeper truth Buffett discovered was that consistency beats cleverness. Look at his major holdings. Apple, held since 2016. Coca-Cola, held since 1988. American Express, held since 1964. Hill-like patience, mountain-like consistency. Meanwhile, the average investor holds stocks for 11 months, changes strategies every market cycle, chases performance is like water seeking new channels. Result, the S&P 500 returned 10% annually over 20 years. The average investor returned 2.9%. The difference? Hills versus water. The water and hills principle teaches us successful investing is boring. No daily excitement, no constant action, no thrilling trades, just patient capital allocation, like hills enduring through seasons, like mountains weathering storms. Choose your nature, water or hills. Water is exciting, but it evaporates. Hills are boring but permanent. But being a hill requires understanding cycles. Proverb 5. Fall down 7 times, stand up 8. You expect every investment to work perfectly. No losses, no mistakes. Straight lines to wealth. Perfection or panic. Ancient Chinese warriors understood something modern investors refuse to accept. Failure is education in disguise. Losses are tuition for wisdom. Mistakes are teachers, not enemies. Warren Buffett has failed more than most people try. His biggest lesson came from his biggest mistake. Berkshire Hathaway itself. Originally a failing textile company. Buffett bought it cheap in 1965, thinking he could turn it around. Classic value trap. The textile business never recovered. Technology made it obsolete. Buffett lost millions on manufacturing, his first major investing failure. But instead of quitting, he learned from the mistake. Never again would he buy declining industries, no matter how cheap the price. From that failure, he developed his greatest insight. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The deeper truth Buffett discovered was that failures become foundations. His other famous mistakes. Dexter Shoe Company, $3.3 billion loss. IBM investment, $2 billion loss. Energy Future Holdings, $873 million loss. Each mistake taught invaluable lessons. Each failure improved his judgment. Each loss made him a better investor. Young investors today expect perfection. They sell after one bad quarter. They abandon strategies after one loss. They interpret normal volatility as personal failure. Buffett thinks differently. He expects mistakes. He budgets for failures. He uses losses as learning laboratories. His batting average isn't 100%, it's probably around 60%. But his home runs are so massive, they overwhelm his strikeouts. The 7 times 8 principle teaches us resilience matters more than perfection. Professional baseball players fail 70% of the time. Hall of Fame hitters fail 65% of the time. Michael Jordan missed more shots than most players ever attempted. Success isn't about avoiding failure. Success is about learning from failure faster than your competition. Stand up 8 times. Learn from 7 failures. Build wisdom through wounds. But wisdom alone isn't enough. Proverb 6. The person who says it cannot be done should not interrupt the person doing it. You listen to financial media experts. The market is too high. This time is different. You can't beat the market. Ancient Chinese builders understood something modern experts forget. Critics talk while builders build. Doubters debate while doers do. Experts explain while entrepreneurs execute. Warren Buffett stopped listening to critics in 1965. When he bought Berkshire Hathaway, experts called it a value trap. Declining industry, hopeless investment. When he bought Coca-Cola in 1988, experts called it overpriced, mature company, no growth potential. When he bought Apple in 2016, experts called him hypocritical. He doesn't understand technology, too old to learn new tricks. Each time, Buffett ignored the noise. He did what others said couldn't be done. While they talked, he bought. While they worried, he prospered. Result, $120 billion net worth, built by doing what couldn't be done. The deeper truth Buffett discovered was that expert opinions are worth exactly what you pay for them. Consider the track record of expert predictions. 1987, Black Monday will destroy capitalism. 1999, internet stocks will never crash. 2008, real estate always goes up. 2020, COVID will end the stock market. Rum. Meanwhile, Buffett ignored predictions and focused on fundamentals. He bought quality companies at reasonable prices. He held them through market storms. He did what experts said was impossible, beat the market consistently for 60 years. The doing not doubting principle teaches us, action beats analysis. While others consume financial media, successful investors consume financial statements. While others debate market timing, successful investors buy quality businesses. While others predict crashes, successful investors prepare for opportunities. Stop listening to people who don't have what you want. Start following people who've already achieved what you seek. Critics will always exist. Builders build anyway. That's the difference between poverty and prosperity. But building requires one final insight. Proverb 7. The best time to plant a money tree is today. You postpone investing until conditions are perfect, waiting for market crashes, waiting for more money, waiting for certainty in uncertain times. Ancient Chinese gardeners knew a profound truth. Perfect timing is a myth. Perfect conditions never come. The only perfect time is now. Warren Buffett planted his first money tree at age 11. Not because conditions were perfect, because he understood the power of time. 175 invested in 1942, grown to billions by 2025, not through perfect timing, through early planting. His partner, Charlie Munger, started later. Age 35 versus Buffett's 11. Same strategies, same wisdom, different results due to timing. Buffett's wealth, 120 billionaires. Munger's wealth, 2.6 billion. Both fortunes from the same seeds, but Buffett planted earlier. The deeper truth both discovered was that time is the most powerful force in wealth building. Consider two investors. Sarah starts investing $300 monthly at age 22, stops at age 32, never adds another dollar. Total invested $39,600. Michael starts investing $300 monthly at age 32, continues until age 62, never stops. Total invested $108,800. At age 62, who has more money? Sarah, $1.2 million. Michael, $177. Same strategy, different timing. Time beats money every time. The money tree principle teaches us, starting trumps perfection. $100 monthly starting today beats $500 monthly starting in 5 years. Imperfect action beats perfect inaction. Early mediocrity beats delayed excellence. But here's what most people miss. You don't need to start big. You need to start today. Buffett's first investment, 3 shares of stock. That, his first business, selling newspapers. His first partnership, $105,000 in assets. Small beginnings, massive endings. Every billionaire started with their first dollar. Every fortune began with a single investment. Every money tree grew from one small seed. Plant yours today. Water it consistently. Watch it grow for decades. The Chinese were right. The best time was yesterday. The second best time is now. Now you possess 7 ancient Chinese proverbs that built Warren Buffett's $120 billion fortune. Not complex algorithms or advanced mathematics. Simple wisdom passed down through the millennia. Principles as reliable as sunrise. If these timeless truths resonate with your soul, make this commitment today. Choose one proverb and apply it this week. Plant your first money tree. Examine your investment's foundations. Embrace the next market correction as an opportunity. Comment, Ancient Buffett, if you're ready to invest using 5,000-year-old wisdom instead of last week's hot tips. Share this knowledge with someone chasing get-rich-quick schemes. Ancient wisdom might save their portfolio. And tell me below, Which Chinese proverb will change your investing approach forever? Remember this eternal truth that made Buffett the greatest investor alive. Time is the friend of the wonderful business, the enemy of the mediocre. But time only works if you start the clock. Proverbs only work if you apply them. Wisdom only works if you act on it. The Chinese understood these principles 5,000 years ago. Warren Buffett learned them 60 years ago. The question is, when will you? Stop waiting for perfect conditions. Stop listening to expert predictions. Stop postponing your financial future. Start following ancient wisdom. Start thinking like Buffett. Start building wealth like the Chinese masters. These proverbs have been waiting centuries for you to discover them. The money tree is ready to plant. The question is, are you ready to dig?